Welcome to Thoughts on the Market. I'm Jim Egan, co-head of Securitized Products Research at Morgan Stanley.
And I'm Jay Backow, the other co-head of Securitized Products Research.
Along with my colleagues bringing you a variety of perspectives, today Jay and I are here to talk about the U.S. housing and mortgage markets. It's Wednesday, August 28th at 10 a.m. in New York. Now, Jay, mortgage rates declined pretty sharply in the beginning of August. And if I take a little bit of a step back here, while rates have been volatile, to say the least, we're about 50 basis points lower than we were at the beginning of July, 80 basis points lower than the 2024 peak in April, and 135 basis points below cycle peaks back in October of 2023. Big picture, declining mortgage rates. What does that mean for mortgages?
It means that more people are going to have the ability to refinance given the rally in mortgage rates that you described. But we have to be careful when we think about how many more people. We track the percentage of homeowners that have at least 25 basis points of incentive to refinance after accounting for things like loan level pricing adjustments. That number is still less than 10% of the outstanding homeowners. So broadly speaking, most people are not going to refinance. Now, however, because of the rally that we've seen from the highs, if we look at the percentage of borrowers that took out a mortgage between 6 and 24 months ago, which is really where the peak refinance activity happens, over 30% of those borrowers have incentive to refinance. So recent homeowners, if you took your mortgage out not that long ago, you should take a look. You might have an opportunity to refinance. But for most of the universe of homeowners in America that have much lower mortgage rates, they're not going to be refinancing.
Okay, what about convexity hedging? That's a term that tends to get thrown around a lot in periods of quick and sizable rate moves. What is convexity hedging, and should we be concerned?
Sure. So because the homeowner in America has the option to refinance their mortgage whenever they want, the investor that owns that security is effectively short that option to the homeowner. And so as rates rally, the homeowner is more likely to refinance. And what that means is that the duration, the average life of that mortgage that's outstanding is going to shorten up. And so what that means is that if the investor wants to have the same amount of duration as rates rally, they're going to need to add duration, which isn't necessarily a good thing because they're going to be buying duration at lower yields and higher prices. And often when rates rally a lot, you will get the explanation that this is happening because of mortgage convexity hedging. Now, convexity hedging will happen more into a rally, but because so much of the universe has mortgages that were taken out in 2020 and 2021, we think realistically, the real convexity risks are likely 150 basis points or so lower in rates. But Jim, we have had this rally in rates. We do have lower mortgage rates than we saw over the summer. What does that mean for affordability?
So affordability is improving. To put numbers around what we're talking about, mortgage rates are at approximately 6.5% today. At the peak in the fourth quarter of last year, they were closer to 8%. Now, over the past few years, we've gotten to use the word unprecedented in the housing market, what feels like an unprecedented number of times. Well, the improvement in affordability that we'd experience if mortgage rates were to hold at these current levels has only happened a handful of times over the past 35 to 40 years. This part of it is by no means unprecedented.
All right. Now, we talked about mortgage rates coming down, and that means more refi activity. But what does the improvement in mortgage rates do to purchase activity?
So that's a question that's coming up a lot in our investor discussions recently. And to begin to answer that question, we looked at those past handful of episodes. In the past, existing home sales almost always climb in the subsequent year and the subsequent 2 years following an improvement in affordability at the scale that we're witnessing right now.
So there's precedent for this unprecedented experience?
There is, but there are also a number of differences between our current predicament and these historical examples that I'd say warrant examination. The first is inventory. We simply have never had so few homes for sale as we do right now, especially when we're looking at those other periods of affordability improvement. And on the affordability front itself, despite the improvement that we've seen, affordability remains significantly more challenged than almost every other historical episode of the past 40 years, with the exception of 1985. Both of these facts are apparent in the lock-in effect that you and I have discussed several times on this podcast in the past.
All right. So just like we think we're about 150 basis points away from convexity hedging being an issue, we're still pretty far away from rates unlocking significant inventory. What does that mean for home sales?
So the U.S. housing market has a supply problem, not a demand problem. I want to caveat that everything is related in the U.S. housing market. For instance, high mortgage rates have put pressure on affordability, but they've also contributed to this lock-in effect that has led to historically low inventory. This lack of supply has kept home prices climbing despite high mortgage rates, which is keeping affordability under pressure. So when we say that housing has a supply problem, we're not dismissing the demand side of the equation, just acknowledging that the binding constraint in the current environment is supply.
All right. So if supply is the binding constraint, then what does that mean for sales?
As rates come down, inventory has been increasing. When combined with improvements in affordability, this should catalyze increased sales volumes in the coming year. But the confluence of inputs in the housing market today render the current environment unique from anything that we've experienced over the past few decades. Sales volumes should climb, but the path is unlikely to be linear, and the total increase should be limited to, call it, the mid-single-digit percentage point over the coming year.
All right. And now lastly, Jim, home prices continue to set an all-time high, but there's the absolute level of prices and the pace of home price appreciation. What do you think is going to happen?
We're on the record that this increased supply, even if it's only at the margins and even if we're close to historic lows, should slow down the pace of home price appreciation. We've begun to see that. Year-over-year home price growth has come down from 6.5% to 5.9% over the past 3 months. We think it will continue to come down, finishing the year at plus 2%.
All right, Jim, thanks for those thoughts. And to our listeners, thank you for listening. If you enjoy the podcast, please leave a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.